Start recording the. Yeah, I think am I audible properly?
Yes, sir.
Yeah.
We may start maybe in 5 minutes. Just let's see others are there.
Yeah, absolutely. Hmm? Ah. Okay, so I'm just continuing last topic. Um, Last topic of factoring. So I'm just prepared one example. Okay, so what happened? Sometimes we may get a question whether we need to go with a factoring or whether we need to take a bank loan. Okay, so I'm just create the hypothetical example. So if we have an AR of 55 lakh, okay, and the factorer is okay to finance 90% against the 55 lakh, okay. So it is basically he is giving in 49 lakh 50,000, okay, and bank may give a loan of 50 lakh, okay. So we need to evaluate whether we need to go with the factorer or with a bank loan, okay. So here some data, like the factorer may charge a fees of 2% per month, okay, and if we need amount for 3 months, say for period is 90 days. Means all bills get due in 90 days. Okay. So how we are going to calculate? So first 49 lakh 50,000 multiplied by 2% multiplied by 90 divided by 365. So this is my factoring fees. Two lakh 24,500. Just 1 minute. Yeah. It should be 24,004. Okay, so we need to consider 2,97,000. Okay, so in exam you may get the 90 days and 360 like this. Okay, so accordingly you need to calculate, or 365 accordingly you need to calculate. I don't know, I mean, so why 2%. Okay, this is for 1 month actually, so multiplied by 90, okay, 1 month, understood. Okay, so I'll keep a 2% multiplied by 3. Okay, 2% is per month, so that's why 90 divided by 365 is not applicable. Okay, so period is 90 days. Okay, and the like we are able to save 80,000 in a collection efforts. Okay, so exactly the cost of factorer or cost of factoring 2,97,000 minus 80,000, because we are going to save something. Okay, this interest we need to pay. Okay, and like 80,000 is basically the save. So net cost is 2,17,000. Okay, and the advance amount is 49,50,000, because even though the AR is 55 lakh, 10% we will get after 3 months, so that is not an advance amount. Okay, so what is my effective interest rate? Effective interest rate is 4.38%. Okay, and annualize, this is for 3 months. So annualize is it is 17.53%. Okay, so here you do not require to do any separate calculation, because the 12% rate of interest is given. Okay, so you can immediately compare. In examination there is no calculation required actually. Okay, because you need to select the answer from the drop down. Okay, in simulation only you need to calculate. Okay, so if you will get the question in a simulation, then maybe you need to calculate. Otherwise in MCQ, if you get this kind of question, you can immediately evaluate. My if I go with the factoring services, my annualized interest rate is 17.54, and the bank is giving me loan at a 12%. So I need to approach to the bank. But if I need to give like the saving in INR, so it is basically so this is 1,50,000. So here you can compare like this. Okay, so you can calculate the amount. Okay, but mostly in exam you just need to finalize the answer. So once you get the 17.54 annualized effective interest rate for a factoring service, then you can easily compare with the bank rate of interest, and you can get the answer. Any doubt here? So this way you need to compare whether you need to opt for a factoring services or you need to go with a bank loan. Any doubt here? Okay. Now we need to go with inventory management. Okay, Okay. So in books, we generally saw there are three, inventory we need to classify in a raw material, work in progress and finished goods. Okay. So raw material is basically in a raw form. Okay. So that we need to use for a production. Okay. WIP is basically in production process. Production is not yet completed. And finished good is completed. Okay. So we generally classify the inventory in this three categories. Okay. Raw material, work in progress and finished goods. Okay. So factors influencing inventory level. Influencing inventory level. Okay. So first, storage cost. Why storage cost affect the inventory level? Any guess? Why storage cost affect inventory level?
Sir, because of there's more storage cost, then we can't invest that money in buying inventory.
Yeah, correct. So if storage cost is high, then we need to prefer just-in-time process. Okay, you cannot you cannot absorb additional overheads in terms of the storage. Okay. Second, insurance cost. Okay. So insurance cost is again more like a storage. Okay. So if you store it for a more number of period, okay, then you need to pay the premium for a higher period. Okay, so you need to pay the premium for a higher period. Okay, so that's why insurance cost is also affect the inventory level. Okay, so if insurance cost is less, then you may be store for a more period. Okay, then opportunity cost of inventory investment. Okay, can you explain what is the opportunity cost of inventory investment? Means what thought came in your mind?
Second, best alternative use of the money deployed in inventory.
Yes. Or you can reduce your working capital. Can reduce working capital and thereby save in interest. Okay. Yeah, absolutely. The one point is like you can reinvest at some other opportunities. Okay. And then the lost inventory due to obsolescence or spoilage. Okay, if the chances of obsolescence is very high, then it is better to procure just in time basis. Okay, and if you can use the inventory in a perpetual mode, then maybe you can buy in a bulk if the storage cost is less, Okay, so that you can get the benefit of quantity discount. Okay, so this way means this factors affect the inventory level. Okay, do you know? I mean, do you think that some other factors can affect the inventory level? Any guess?
So the trends which is happening in the market.
Correct. Trend. So many factors.
So cost of raw materials. If it increases, then you can't keep that much
Yes.
inventory.
Prospects on cost of raw material. Some more.
High volatile market.
High volatile market. Right. Any other? Ordering cost. Okay, if the ordering cost is high than the storage cost, then we need to increase the inventory level. Lead time at supply rate. If you are procuring the material from India, then it is easy, or you can keep a minimum lead time. But if you are importing, then you need to keep in a stock. Okay, then production capacity. Okay, so if you have a, see what happened, like even though you don't have a order, okay, but you have a spare capacity. So sometime management may take a decision, okay, some standard products we are going to manufacture. Okay, even though we are not going to sell, but maybe whenever we get an order, we can take a benefit of lesser delivery time, and we may offer to the customer with some premium. Okay, so that management can take a call. So production capacity also influence the inventory level. Okay, so these are, means there are a number of other factors as well, but these are the some factors which you need to keep in mind. Okay, so now optimum level of inventory. Okay, so what is the optimum level of inventory? Where means if we compare the storage cost, if we compare the demand, if we compare ordering cost, okay. So in all situation, we find that the cost of carrying inventory is less. Okay, so that is basically the lowest level. Okay, so that is basically the optimum level of inventory. Okay, so we go one by one. So how inventory turnover affect the optimum level of inventory? Okay, Okay. So what is basically the inventory turnover? Anyone has any idea?
How fast the inventory is, we are ready to bring the number of inventories in the company. How many stocks we are ready to sell? How it's moving out of the business. It's the turnover of the stocks.
Yeah, times rotate the inventory in a year. Inventory in a year. Okay, so how many times we can rotate the inventory? That is basically the inventory turnover. Say for like if I'm dealing in a standard product, every month I need a 60 quantity. Okay, and I need to keep a stock of 90 days or 3 months. So it is basically 180 quantity. Okay, so my total annual demand is 720. Out of this, I am keeping in a stock 180 quantity, 3 month stock. So this inventory I can rotate 4 times in a year. Okay, so if my optimum level of inventory is high, so that means inventory turnover is less. Okay, and if my optimum inventory is less, then my inventory turnover is high. Are you able to understand? Are you able to understand this issue? So it is inventory turnover inversely proportion with the optimum level. Because of lead time and ordering cost, okay, if I need to buy or keep a stock or a minimum order I need to buy is 1000 quantity and my yearly requirement is 2000 quantity. What does it mean? I am able to rotate my inventory 2 times in a year. Okay, but if my optimum level of inventory is 500 quantity, okay, and my yearly demand is 2000 quantity, that means I can rotate the 4 times. Okay, so if optimum level inventory goes down, my optimum level inventory goes down, my inventory turnover goes up. So this is basically increasing. Okay, so that is basically the how the inventory turnover is correlate with the optimum level of inventory. Then safety stock. What is safety stock? What is safety stock?
The minimum amount of stock that it will maintain.
Yeah. Minimum amount of stock to be maintained. How we are going to calculate the safety stock? Any guess? Just a general idea.
So is it by seeing the amount of normal sales we can ascertain how much we need?
Okay. So I'll just, yeah, on the basis of normal sale, absolutely. Beside this, any one more factor.
Based on demand,
So demand and sale is more or less same. One more factor. Any guess? Anyone? Lead time from the supplier. That is the important factor actually. Okay, in my company, means how I am going to calculate. Okay, so means I will give you the two calculation actually. Max usage per day, maybe it is per day. Okay, maybe you can consider the 120 quantity, and the maximum lead time. Okay, that is maybe the 7 days. Okay, and average daily usage, and average lead time. Okay, so it is basically the 100 quantity and 5 days. Okay, so this is 840 and this is 500. So what would be my safety stock? Actually, because the one point we have not covered the reorder point actually. Okay, so that's why what I want to explain. Okay, so that maybe you may face some difficulty, but once we cover the reorder point, you will be clear on this point. Okay, so in this two scenario, what is my what should be my safety stock? Any guess?
so they subtract the maximum and average
Yeah, correct.
to get the minimum.
Minimum. Yeah, so that should be my safety stock. Okay, see what happened, sometime people may say this should be the safety stock. Okay, but that we are already covering our reorder point level. Okay, so this should not be my safety stock. Okay, so we need to, whenever my stock level goes down below 500, I am going to reorder. Okay, so that's why my safety stock should be 340, which is 840 minus 500. Okay, because like whenever the stock goes below 500, okay, so automatically I am going to order 340 is with me. Okay, so it is 500 plus 340, that should be my reorder. Okay, we will see. Okay, so now what is reorder point? Okay, so as we just discussed, 840 is my reorder point. Okay, 500 is my basically how I can say use average usage during the goods in transit. Okay, and the 340 is my safety stock. So 840 is my reorder point. So you can calculate maximum reorder point as a maximum sale and the maximum lead time. That is my reorder point. Okay, so reorder point is when the stock goes below 840, you need to place an order. Okay, and safety stock is basically whatever may be the maximum usage when the stock in transit, and average usage when the stock in transit, and the difference between these two. Okay, so my reorder point always is the maximum quantity usage and the multiplied by maximum lead time. Then economic order quantity. So economic order quantity economic order quantity with example we need to see. Square root of 2 annual demand ordering cost divided by carrying cost. Yeah, carrying cost. Okay, that is basically the formula for um, 2 multiplied by sale is basically the annual demand. This is ordering cost, and this is carrying cost. Carrying cost. Okay. Yeah. Okay. So, like when the ordering cost increases, okay, so we try to try to reduce the number of orders, okay, because the per order cost is high, okay, and when the carrying cost increases, okay, we try to increase the number of orders. Okay, so this way you can keep in mind the formula. Okay, so when the ordering cost increases, we are trying to reduce the number of orders, and when the carrying cost increases, we are trying to increase the number of orders. So that's why the carrying cost always in a denominator. Okay, so now we can take an example here. It is a simple, I mean, so you need to memorize this formula. Okay, so Maximus company incurs cost of $50 per unit per month carrying cost. So carrying cost is below. Okay, and each order cost is of the firm is 5625. So multiplied by 5625 goes through 100 unit monthly. Per month. Okay, so that also you need to keep in mind. See what happened in this example, the $50 per unit per month. Okay, order cost always is a static. Okay, and the quantity demand is 100 unit of per month. Okay, if the one cost you will get yearly and the one cost and the order quantity yearly, then you need to calculate both the yearly cost. Okay, so say for 100, I mean, instead of 100 unit inventory monthly, if it is given 1200 unit, requirement is 1200 unit in a year, then that 50 also you need to annualize, or the 1200 unit you need to, I mean, say if it is an annual unit, then you need to first convert in a monthly requirement. Okay, so here 2 multiplied by 100. So that is basically we are calculating for 1 month. Okay, so my per month economic order quantity is 150 unit. So it is per month. Okay, so this way you need to keep in mind. Now, just-in-time inventory model. What is just-in-time? Okay. We need to maintain the minimum inventory. Okay. So whenever there is a requirement on a shop floor, okay, so we immediate call to supplier and supplier directly deliver the inventory in a on a shop floor. Okay. So this we can utilize when lead time is 0. Okay, lead time is 0 and there is no requirement for the storage. If the storage cost is high, okay, so then we need to follow the just-in-time inventory level. Okay, then this is the first. Second, production department. Okay, it is basically the pull system. Pull system means generally we use the just-in-time inventory level when we are manufacturing the customized product. Okay, customized product means on the basis of customer order. So we cannot predict what the customer need, and because of that reason we are unable to store the material. Okay. Then we need to have a close coordination with the supplier. Okay, because see what happened, we are not storing at our level, so we need to control the supplier for getting an inventory on timely manner. Okay, so we need to continuously in touch with the supplier so that whenever we need a material on a shop floor, okay, he can immediately fulfill the requirement. And then there should be a continuous flow. The flow should not be break. Okay, so here what happened, the main issue is basically inventory stored by the supplier. Okay, you cannot start a manufacture only when you have an order. So it is basically the inventory stored by the supplier. Okay, and then as we are bringing the inventory directly on the shop floor, or on shop floor, okay, you need to be complete the quality check at supplier end. Supplier end. Okay, so these are some factors. Okay, so that you can understand means what is the just-in-time inventory model. In just-in-time, what happened? We are not storing the material at our end. So where we are going to store, we are storing it with the supplier. Okay, to be successful in a just-in-time, we need to have a close coordination with the supplier. Okay, we need to do a quality check at supplier end. Okay, it is basically the pull based, means whenever we need whenever there is an order, we need to approach to the supplier to get the material. Okay, so this is basically the some factors of the just in time. Then Kanban inventory control.
So just in time is based on the job process, right? Based on the I mean, demand itself, the product is being made by the manufacturers.
Correct. On the basis of, if it is a customized, then and only then it makes sense. See what happened, I mean, in a practical situation, no supplier is willing to support or maintain an inventory level at their end. Okay. So if if you are manufacturing the homogeneous product, okay, or the standard product, okay, then he may not willing to work on a just-in-time basis. Okay, he may push you to keep a stock at your end. Okay, but if it is a like how I can say, the customized product, means you don't have idea in advance what product you need to manufacture. Okay, so it is when the, I mean, the whatever may be the raw material or brought out component we required, that is mainly depend on the customer requirement. In that situation, we need to organize the supplier, or the supplier should work with us on a just-in-time basis. Okay, because if we sell the material and we find that we don't require it, so it will be an unnecessary inventory for us. Okay, so that's why whenever we are manufacturing the customized product, okay, we mostly prefer with a just-in-time inventory situation. And the second criteria is basically when the cost of inventory is very high. Okay, so in that situation also we need to work on a just-in-time basis. Even the supplier is also work on a just-in-time basis. Kanban inventory control. See, in Kanban inventory control, it gives the visual signal through cards oblique any software, okay, which indicates inventory need to replenish. Okay. Replenish. Okay. So, like, I mean, so when you see the third one, the computerized inventory control, so it is also more or less the kind of Kanban inventory control. Okay. In Kanban, when we maintain a card, okay, and that card have a fixed quantity. So once that card, I mean, the quantity available on that card get diminished or zero, that card automatically sends a signal to the procurement department or sometime to the supplier directly. Okay, and whatever the quantity available on this card, that get replenished by the procurement department or the supplier. Okay, and the same way computerized inventory control.
So, sir, that won't affect the whole process of the manufacturing?
No, it will not affect, because see what happened, every card we maintain a safety stock. Okay, so because of that reason, whenever the in a card the inventory level goes down below a particular level, okay, so it gets automatically triggered to the purchase department or the direct supplier, and they will replenish this inventory. Okay, so it is basically, means how I can say, like we have a credit cards, okay, and then if the balance goes down, or like FASTag, when the balance goes down, it is automatically recharged by the bank account, like this, okay. So it is when there is a production process, okay, or the manufacturing unit, so they generally use the card system, okay. Computerized inventory control, it is basically when there is a principal and dealer network. Okay, so in that situation, what happened? When the particular dealer has a some quantity, okay, and it goes down, so automatically the dealer system raise PO on principal. On principal or OEM. Okay, so this way we are managing the inventory level. So here basically what we are doing, we do the planning in advance, and when we come to know the particular product, the stock of particular product goes down, okay, so it is automatically raise the purchase order on the supplier, okay, in computerized inventory control, okay, and accordingly you will get the material, and on the basis of that purchase order, the supplier is also sending the material. So this way it is, there is no much human intervention. So Kanban inventory control we generally use in a manufacturing units, okay, and the computerized inventory control we generally use in a trading organization. Supply chain management and integrated supply chain management. So we can see the practical example of supply chain management. Okay, so first, okay, so what, can you tell me, what is supply chain management? Or how I can say, like, how it, the point when it is started. Any guess?
It indicates how the product is being supplied from the manufacturers to wholesalers, retailers, all the service providers.
Customers. Or the
Yes.
customer. Okay. But when the process of supply chain started, from the procurement of material, from this stage or any other? So supply chain management started from getting the order from the customer. Okay, generally, if you see, most of the people keeps on telling, like it has started from the procurement of the material and end with the distribution to the customer. But my like observation is, like it is once you get the order from the customer, then you need to facilitate everything so that customer will get the material on time. Okay, so from my point of view, it is started when we receive the order. not the procurement of the material, because the means if I receive the order, then I start to see means what I want to manufacture, what I want to procure. Okay, so I generally consider it is started from the date when we get the order from the customer. Okay. So once we get the order from the customer, then we need to evaluate whether the whatever the raw material required. If it is in stock, then no issue. And if it is not in stock, then we need to see how the procurement work on it. Procurement, sourcing, any department means. Okay. Once you like procurement raise the PO. Okay. Once if it is a stock, then no issue, but otherwise you need to go to procurement, raise the PO, okay, and then the SCM should need to evaluate the delivery time. Okay, on that basis they keeps on updating to the customer for dispatch time. Okay. So, like once we raise the PO, then so SCM ascertain the delivery time, and then they organize the inbound logistic. Means organizing the material in a factory. Okay. Okay. Once the material organized in a factory, then they coordinate with the production department. Okay. And production department plus inventory management, of course. Okay, because we need to produce as per the customer expectation. Sometimes what happened, the processing time is less, okay, and the customer delivery time is which is they need a delivery after some time. Okay, so in that situation makes no sense to produce. Okay, so that's why the product whatever may be the the processing time and whatever may be the inventory management, that need to consider. Once the product is produced, then they need to work on a dispatch or outbound delivery. Okay, so then the material reaches to the customer. Reach to customer. Okay. After that, once it is not like this, here the SCM role finish. Okay. After that, whatever may be the after sale service, that also taken care by supply chain management. Okay, so this is basically, so in short, customer order, supplier, then inbound logistic, after that manufacturing, then outbound logistic, and then after so reaches outbound logistic means customer, and then after sale service. This is basically the cycle or chain for the supply chain management. Okay, so of course, the goal is basically to understand the need and preference of the customer. Means when they need the material. Okay, so we always need to negotiate with several factors so that we can deliver the material to the customer as per his requirement. Sometime like the delivery time is less, okay, than the processing time. Okay, so in that situation the SCM team needs to negotiate across all the departments or all the stakeholders and try to see how they can reduce the processing time. Okay, and sometimes the processing time is less and delivery time is high. So in that situation the supply chain management need to coordinate with all the stakeholders so that there should not be any unwanted holding period. Okay, so they need to organize the material as and when required. Okay, so like this we need to work. Okay, then supply chain operation reference model, so score model.
So during the COVID time, surely there was huge inventory storage cost and all the other factors. So and how the supply chain management was being working, how the supplier was able to sell the products, how it was, how they were carrying all the costs, because they were having the huge cost and huge inventories in the products.
Okay, I tell you something. See, in COVID time, the storage cost is very less. Okay, the reason is because most of the see what happened. Only if you see in an industry, okay, so 25% is a essential goods manufacturing industry, and the 75% is non-essential. Okay, so like the car manufacturing is not an essential. If you are at home, no one want to buy the car. Okay, so I'll give a practical example because at that time I was with one company and we are facing to get the material. Okay, so we are basically delivering the equipment to pharma industry, and for that we need some like the chips which is also used in a laptop. Okay, in COVID period, what happened? Like there is a sudden requirement of the laptops because now because everybody need to work from home. So whatever the chip we need to manufacture our product. Okay, the priority goes to the laptop. Okay, because the demand for the laptop is very high. Okay, so because of that reason we are not, I mean, there is a short supply of a particular product. Okay, and because of that reason we are not able to get the material. This is one aspect. Second aspect is the transportation, because everything is closed. Okay, so it is not easy to get the material. Even though the supplier has the material, okay, he is not able to transport. Okay, so at that time most of the entrepreneurs who are dealing in essential goods, okay, they need to started to stock at infinite level, because no one knows whether the COVID period extend to 9 months, 12 months, 1 year, 3 years. Okay, so storage is an easy task at that time, but the procurement is very difficult at that time. Okay, so everybody is ready for overstocking. No, they are not concerning the kind of order they have or something like that, but they want to stock as much as possible. But because of the short supply, because of alternate use, and the second limitation is transportation. So in that situation, see, if this is an exceptional situation, then you cannot follow the rules and regulation or the principles. Then you need to just means whatever may be the your business demand. As per that, you need to work on it. Okay. Okay, so in score model, if you see the last four word, plan, source, make and deliver. Okay. So you need to always balance between the demand and supply. What is plan? Okay, you need to balance. So how you're going to, means whatever may be the demand, then whatever, means how quickly you can get the supply, you need to plan like inventory level. Your production schedule. Then whatever may be the resources you need, like manpower and everything, and then or transportation arrangement. If you see in most of the industry, if you fails to plan properly, then you need to absorb very high transportation cost. Means I come across so many situations where if you plan in advance, then maybe you can get the material by ship, and the cost of ship is very less than the air freight. Okay. But if you fails to do the plan in advance, then you need to absorb the very high cost of air freight. Okay. Then source. Okay, source means procurement. Okay, so you are going to procure goods and services to meet the planned or actual demand. Okay. See, generally we mostly talk about the goods. Okay, whether we are able to get the goods on a time or not. Okay, but it is also difficult to get the skilled people. I came across so many situations where we have all the material, okay, but we don't have a skilled people so that we can complete the assembly or any design activity, and we can dispatch the material to the customer. Okay, so service is also one of the things which we need to focus as a procurement area. So again, in source, what work we do generally, identify the supplier, then we negotiate with the supplier, contract, then we need to manage the supplier. Manage supplier means, any example? Sometimes, see what happened, we have a supplier, I mean, so my requirement is high, okay, but like the supplier don't have a single supplier don't have a potential to complete my order. So what I need to do, I need to bifurcate the order in 2-3 supplier. That also we need to manage, and plus the relationship with them, so that they can supply the material on time. Okay, so there are so many activities in the management of the supplier. It is not so easy, just we negotiate and we give the contract. We need to see what is the strength of the supplier, to how reliable is the supplier. Okay, then if we bifurcate the single order in 2-3 suppliers, okay, then how they can coordinate with each other. Okay, so these are the factors we need to see. Then make. Okay, make means generally the production or conversion of raw material to finished good. Okay, so this include all the production practices like production, assembly, then like quality, public testing, and last is packing. These are all make, and last is deliver. Deliver means like order management. When to deliver, that is more important. Order management, warehousing, after that transportation, invoicing, and collection. Collection is also the important. Sometimes the payment term is like 70% before dispatch. So we need to collect the 70% before invoicing. So that is also the important factor. Okay. I mean, you need to understand basically that these are whatever I am listing. This is not the only work. There are lots of planning required. I am giving a one practical example. Maybe you heard US started or announces that they are going to charge anti-dumping duty. Okay, so that the cost of Indian like product high in the US. Okay, so in that situation, I mean, sometime what happened, we want to supply some material to US party, which he is going to supply to other country. Okay, so we need to evaluate that whether we should, I mean, in this scenario, whether we need to supply to the US or directly to the third party. Okay, so this kind of lots of work or permutation combination we need to do while doing all this activity. Okay, so here they gave plan, source, make, and deliver, but I'll add one more point, which is basically return. Okay, so if like product is not accepted by the customer, then they may return the product. So that also we need to manage. Okay, so that's why I'm just keeping one additional point. So this is basically the supply chain operation reference model. Any doubt, any point here?
So the perishable goods have been manufactured through just-in-time model because we cannot keep for a longer period of time.
Correct, absolutely. So right now, see what happened. There are so many cold storage, so they allow for an extended period. But still, we generally see the market where we can immediately sell. Just a minute.
So, if there is a slow moving item, so what will be the benefit if I choose from two of the below options, either to sell in the scrap or to keep for the longer period of time? Slow moving item.
No, no.
This is the beneficial option, sir.
See what happened if it is a slow moving item. Okay. So then I generally suggest we need to evaluate if we don't have, say for, if we don't have any alternate usage in the span of next 2 to 3 years. Okay. So even if I sell at 50%, it is better I can utilize this cash to some other project. Okay, so generally what happened in every organization, there is an, 6 monthly or yearly review on a slow moving item. And if they find they don't have a sufficient project or sufficient scope to utilize those products, in that situation, generally we sell it at whatever may be the prices. I mean, scrap is last alternate, but before that we try to see the market, like who can use this product on maybe at a lesser price. That is okay, but we try to sell it. We are not going to concentrate the inventory just because someday we are going to use.
Okay.
Okay. So now the account payable. So account payable management. Trade credit, it is the simple one. Like whenever we get some material, okay, we are not going to pay immediately. Not paying immediately. Okay, what we are going to do, we took a credit of say for 30 days to 45 days. Okay, so as we saw in a cash conversion cycle, okay, operation cycle, whenever we reduce the deferral payment to supplier from the operation cycle, then we will get the cash conversion cycle. So it is always a privilege with us that we are going to pay at a later date. Then accruals. Okay, so accrual is basically the provision. Generally what happened, we follow the matching concept. Matching concept in accounting. So when the expenses is for a particular period, but it is not, the supplier is not billed to us. So in that situation, we need to provide or we need to accrue those expenses. Okay, so these are mainly the wages. Okay, wages, say for the year end is 31st December and the wages for the period 1st December through 31st December, we are going to pay on a 7th Jan. Okay, so in that situation, we need to make a provision for the wages or accrue the expenses. Wages on 31st December. That is basically the accrual. Okay, so see what happened, if a particular expenses is related to, there are two ways we are doing an accrual. If a particular expenses is for the period, okay, then we need to accrue even if if invoice is not raised. If invoice is read, then we need to account. Okay, Second point, when we recognize a revenue, say for like we bill to Tata Motors for one machine. Okay, 100% billing done. Okay, but against that billing, some expenses are not booked because the supplier is not gave the invoice. Okay, not book, supplier not gave the invoice. Okay, so in that situation also we need to accrue the expenses. Okay, if it is for a particular period, okay, so then we need to accrue the expenses, and if it is for a particular order for which we complete the work and we deliver the product. Okay, so in that situation like against that order or against that work, if I supposed to get the invoice from my supplier which I have not received, in that situation I need to accrue the expenses. Okay, so that is basically the accrual. Then discount. So discount is basically like supplier give us some credit period, say for 30 to 45 days. I'll consider the 45 days. Okay, it's 45 days. But he may give an offer, if you pay in a 10 days, then you can get additional 2% discount. So that is the discount. Okay, like the way we are approaching to our customer for speedy collection, our supplier also may approach to us for the speedy collection. Okay, so that is basically the discount. Okay, and the same way we need to calculate the discount. Okay, we already saw this in account receivable. Okay, so discount calculation is yearly discount, effective yearly discount percent. Effective discount percentage yearly. Okay, so if you see, if the supplier giving a 45 days credit and if we pay in a 10 days, then it is a 2%. Okay, so first we need to calculate, means I am just reversing this formula. First I will consider the discount. So I have a 2% discount on my net payment of 98. Okay, so this is for one cycle. This discount is for one cycle in a year. Okay, how many times I am going to make a payment, that we need to consider. In a year there is a 360 days. Out of that, that deferment is for 45 minus 10. Okay, like 35 divided by 360 divided by 35. So formula is 2 divided by 98 multiplied by, this is the discount per cycle. Now I am going to calculate the number of cycle, which is in a year there are 360 days, and I am deferring first single payment for a 35 days. Sorry, not deferring. It is basically I am paying early or in advance of 35 days. So for one cycle I need a 35 days, and then I need to consider the 360 days in a year. Okay, so that is my discount percent. So if I calculate in an Excel, two divided by 98 multiplied by 360 divided by 35. So it is 21% roughly. This is my yearly discount. Okay, and then I need to compare the bank interest rate. If the bank is paying me, bank charge me a 12% interest rate yearly. Okay, so whether I need to take a bank loan or I need to utilize the discount opportunity. Any guess? See, if I use the discount opportunity, then I may save the 21%. Okay. And if I use, I mean, discount opportunity, but I need to sacrifice 12%. Any guess? If I use the discount facility, I can save 21% yearly, but for that I need to sacrifice 12% interest rate. So should I go with the discount facility or not? Any guess? Okay.
We can choose, sir.
Yeah, we should go because I'm saving at 21% against the additional cost of 12%. So I'm in net, I'm getting a 9%. 9% saving. So we should opt for a discount facility. Okay, we will see this example. Companies main vendor offers a quick payment discount of 110, means in the 1% if I pay in a 10 days, net 30 days to its customer. So again we need to see 1% discount I am getting on my 99 payment. Okay, multiplied by my cycle, I need to calculate the number of cycle, which is 360 divided by 30 minus 10, because the 20 days I am paying in advance. So it is basically 18.18, means 18.2%. Okay, if the bank interest rate is 20%, okay, in that situation I should, whether I should go with the discount or what? If I take an interest discount, then I may need to, I have a saving of 18.18%. Okay, but for that I need to sacrifice 20%. Should I use the discount? Any guess? So if I am gaining 18% by losing a 20%, makes no sense to take the discount. Okay, so in this scenario, I'll not, I'm okay to pay after, I mean, on 38 days. I'm not going to take a discount. Okay. Okay. So, okay, we will take a 15-minute break here. Okay. So we'll gather 9:45. Okay. Yeah, am I audible properly? Hello? Hello? Yeah, हेलो.
ओके 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 सर वही चेक कर रहा था
आवाज भी आ रही है ना सुदीप? तो am I audible? Am I audible properly? Hello. सुदीप, तो आवाज आ रही है क्या मेरी?
No, sir, no, sir.
ओके, एक
You are not able to.
जस्ट मिनट. Can you hear me now?
Yes, sir.
Okay, okay, yeah. Okay. Okay, so now the factors affecting the discounting policy. Discount policy. Okay, so what are the factors affect discount policy which is used by the supplier? So first, whether the company has a cash on hand to pay that particular vendor.
Sir, we are not able to see your screen if you are sharing.
Sorry. Yeah, now you can see. Sorry. Yeah. So factors affecting discount policy. So cash on hand with the company. Okay. So this is the first thing. If the company has a surplus cash, okay, means they are not able to earn anything on this surplus cash, then they should go with the discount policy. Okay. If the company don't have a surplus cash, then they need to compare with the bank interest rate and then decide. Okay. We saw two example. before break. Okay, so where in the first case, the annualized discount benefit is 21% and the bank interest rate is 12%. And in second case, annualized discount rate is 18% or the discount benefit rate is 20%. Okay. So in first case, we decided we need to go with the discount policy, supply discount policy. In a second case, we decided not to go with the supply discount policy. Okay. Why? Whatever benefit we are getting, the cost of financing, bank cost of financing is less. Okay, then we can go. Okay, and if the bank financing cost is high, then whatever the benefit we are getting, if we go with the supply discount policy, then it makes no sense. Okay, so first thing, if you have a surplus cash, means you are not able to earn anything. Okay, then you should opt for a discount policy. But if you don't have a surplus cash and you have an option to take a loan from the bank or credit line from the bank, in that situation, you need to evaluate what is the annualized benefit against what interest you need to pay to the bank. Okay, and accordingly you need to decide. Company wants to preserve its cash position for other purpose. Okay, so annualized benefit is 21%, say for, but instead of taking this benefit, if they invest in a some other investment project where they can earn 40%. Okay, so in that situation also it is wise that not to take the benefit. Okay, see what happened. You are able to get the loan with a 12% interest. 12% interest. Okay, now you have a two option. Either you can take the benefit of discount policy or you can reinvest. Okay, then you need to compare. Means here the one decision is clear that you are going to take a loan for a 12%, but now you need to evaluate whether you are applying or utilizing for supplier payment or for some other opportunity. Okay, so here you have a other opportunity which gives you the 40% rate of return. Okay, so you are okay to sacrifice 21% benefit and you should go with the 40% rate of return approach. Okay. And the last one is there is potential to negotiate even more favorable terms with the vendors, including greater discount or a longer discount period. So that is basically the negotiation factor. Okay, so you can, whenever you are getting an like for this case, second case which we saw, 18% is basically the annualized benefit against 20% bank interest. So here you can discuss with the supplier and may negotiate so that you can get the 35% benefit and then you are okay with the 20% payment of bank interest. Bank interest, annualized benefit, fit from supplier. Then electronic fund transfer. So it is basically you can immediately transfer the fund. So the electronic movement of fund from one institution to another is called electronic fund transfer or EFT. Electronic fund transfer can be used to ensure the timely payment. Okay. Then optimal vendor payment schedule. Optimal vendor payment schedule. Okay. Okay. So first we need to see what factors affect the vendor payment schedule. Okay. Can anyone tell one by one? Why we need to evaluate what would be the optimal vendor payment schedule? Okay. See, if we are having a benefit to deferral as much as possible, then why we are going to make a payment on due date? Any point? First, we need to maintain repo with supplier. It should not be the case supplier should not supply the material, okay, or he's means before supplying he insists the payment, okay. He should not create any panicness on a on a last minute, okay. So you need to maintain a repo with the supplier, and for that you need to make sure you can take a deferral benefit only which accommodated by supplier freely, okay. So this is first factor. Second, you need to evaluate whether you need to go with the early discount, early payment with a discount versus bank interest versus other opportunities. That you need to evaluate. Then, is there any late payment penalty? Then, whether you need a cash for any other purpose, any other, like means you issued the debentures and then maturity of those debentures in a current month, okay. So in that situation, what happened last 2-3 months, we are very much panicked because we need to repay a huge amount to my debenture holder, okay, and because of that reason there may be a deferral in a payment terms, okay. Can anyone tell other than this? Okay. See what happened, you need to assess the working cycle, working capital cycle. Okay, assume, I'm just giving one example, means whenever you work with the industry or any company, that you need to keep in mind, okay. Say for my average receivable is 50 days. Inventory conversion means once I get the inventory, okay, that is basically the 180 days. Instead of 50, I will keep it 60 so that it is okay. Means when you are delivering a capital equipment, you need almost 180 days to manufacture the inventory. Okay, what is this? Then it is a 240 days. Okay. we cannot control the debtors. Okay, keep in mind, generally we cannot control the customers, or controlling the customers is a difficult task than controlling the supplier. Okay, whatever may be the conversion period I required, that is I required, because there is no scope for reducing the conversion period. Okay, say for like for doing a graduation you may need a like 15 almost 21 years. Okay, so that is the required period. Okay, so that you cannot change. The same way, like inventory conversion period you cannot change. Okay, so my total operating cycle is 240 days. Bank is ready to give the finance or the credit line which accommodate 60 days working capital, or I can say the 90 days working capital. Okay, 240, 90. Okay, so what is this? The remaining amount, 240 minus 90, 40, 50, 150 days. I have my own finance which may accommodate 90 days credit period. Ninety days credit period. This is own finance. Okay, so I'm at any point of thing or any point of situation, 60 days I need from my supplier. Clear? This way we need to calculate. Okay, own finance is also the limited. Okay, you don't want to, I mean, there is no scope to introduce the amount. Okay, credit line is a fix. Okay, generally the credit line is basically, I'll tell you, I mean, just keep in mind, it is basically the 20% of the turnover. Okay, so 20% of the turnover means 12 month multiplied by 20%. Okay, or 365 days. Okay, this is basically, so bank is giving maximum 73 to 75 days credit period. Okay, so this way you need to keep in mind. Okay, so now I assume here the 90 days, but in India generally bank is supporting for a 70 days. Okay, so you have a average debtor ratio, you have a like average conversion period. You know the bank credit line is able to give the 70 days. Okay, say for you have a working capital finance, your own finance. Okay, if you're doing a turnover of 20 crore, okay, and your own finance is say for sorry 200 crore, and own finance is say for the 40 crore. Okay, so what does it mean? You can finance for a 73 days again. Okay, so it is basically, I consider the 90-90, but it is, you can consider the 75-75. Okay, so then in that situation, 90-90 credit line own finance, so remaining working remaining operating cycle or the that should be absorbed by the supplier. So you need to maintain the average supplier credit period at a 60 days. This way you need to work in any organization. Means whenever you join any organization, okay, and you need to do the working capital evaluation. So you need to first check what is your debtors turnover. I mean, on the basis of last 3 years you can evaluate. If you're growing a business, okay, then you can like proportionately, if there is any change in the debtors terms, okay, credit period, then proportionately you can use this. Proportionately you need to make an adjustment. Okay, and you don't have a much bargaining capacity in front of your customer. Okay, the second point is, then what is your conversion period? Okay, third point is bank is going to support for how much period? Okay, fourth point is what is your own finance? Okay, if you have a infinite finance, then there is no issue. But if the finance is scared with you, okay, so in that situation you need to consider the maximum finance which you can do for the working capital, and the remaining is basically the 60 days. I mean, so then you need to see how you can accommodate your creditors for those period. Okay, so like this you need to do. You can take an example. Rix Corp pays for a gas and electricity cost from Lencor with monthly payment due on 12th of each month. Rather than issuing a paper check from its account payable department, RIGS set up the payment in its automated bill pay system such that the amount due is automatically wired from RIGS bank to the lender on the morning of the 12th. Setting up the payment in this manner allows RIGS to conserve the cash and meet the payment deadline without worrying about the remembering the issue check. Okay. So if you already set a schedule in your system, okay, so then you do not require to worry about it. The payment get automatically processed. Okay, but just keep in mind how you are going to calculate the optimal vendor payment schedule. This also you need to consider. You need to always negotiate with the vendor. If you have a like working capital cycle is more, then you need to get as much as possible support from your vendor. Okay. Methods to delay the disbursement. So it is postponing payment of account payable provide a spontaneous source of credit to which the management can resort if the company is confronted with the short-term cash shortage. Means sometimes if you need a short-term cash shortage, if you face a short-term cash shortage or you have a bigger project or the execution time required to convert the raw material to the finished good requires a slightly higher time, then you need to pass on some load to your vendor. So communication to the creditors that payment will arrive later than usual serve to mitigate the possible damage to the credit rating. So you need to in advance, you need to inform to your vendors. Then line of credit, establishing a line of credit with a bank serves to slow down payment. A line of credit extend the company's trade credit by paying off the company's trade discount with borrowed fund and allowing the company a longer period to pay back that loan to the bank. So as we already discussed, if you are getting a higher benefit by paying in advance to the supplier, okay, then you can like utilize the line of credit. Okay, you can utilize the line of credit and you can pay the interest to the bank. Any doubt here? Okay, now we need to see the corporate banking arrangement. Means there are several working capital arrangement we can get from the bank. We go one by one. LC, line of credit. Anyone have any idea about LC, line of credit? So it is basically the bank guarantee to the supplier that payment will be made upon delivery of the certain documents or delivery of the goods and service and on producing the relevant document. Okay. So like if you see the illustration, so what fun toy companies stocking up for its year-end inventory requirement and seeks to issue the commercial paper to supplier upon delivery of the stock. So toy wholesaler expect a weak sale and are reluctant to accept the unsecured debt. Then would fund arrange for a letter of credit to guarantee payment of its indebtedness in order to ensure the delivery of the inventory. So LC generally we are using in an international trade, but that doesn't mean we are not utilizing for a domestic. It is for utilized for both domestic as well as international trade. Okay, so it is basically a document, okay, backed by the or supported by bank guarantee bank. Okay, what happened if thus means we issue the LC in favor of the supplier, favor of supplier, Okay, when suppliers so when supplier deliver the material, when supplier deliver the material, he when the supplier submit the delivery proof to bank, delivery proof to bank. Okay, and then bank make the payment, bank issue the payment. Bank issue the payment. Okay, so that is basically the LC. Line of credit. Okay, so line of credit is normal CC limit. Okay, so bank given it is basically the revolving credit means you took a credit for one invoice, and once you paid this invoice, you will get the another credit. Okay, and this can be generally it is renewed once in a year. It is like the bank is review the supplier requirement once in a year. Okay, so line of credit represent a revolving loan with a bank or group of bank that is up to a specific dollar maximum amount. Okay, for a defined term and is renewable up to the maturity date upon the maturity. So generally it is 1 year. Okay, any outstanding balance under the line of credit reduce the future availability of the fund. Say for you have a line of credit of 4 million. Out of this, you already utilized 2 million. So now you can utilize only 2 million. Sorry, the same number. So I will 3 million. So now you can utilize only 1 million. If you repay back this 3 million and now it is 1 million, so further you can utilize 3 million like this. So we can see the example. Lance's Stores Inc. is a soft goods general retailer. Though the first 6 months of the current operating year, the company has been able to cover its operating costs and working capital needs, though its internal cash flow generation through its internal cash flow generation and issuance of the commercial paper. As the summer season began to wind down, the retailer is planning to significantly build up a retail inventory for the upcoming holiday season. In order to obtain the necessary capital for this working capital expansion, the retailer draw down 80% of the availability under its master revolving line of credit facility. So several months later, Lenses uses seasonal revolving line of credit to cover its additional retail inventory need. As the holiday season ends, the retailer pays down all the outstanding balances under the master revolving credit facility and seasonal revolving line of credit. See what happened? Like if the particular business entity has a line of credit of say for 40 million USD, okay, in season he use entire 40 million USD, okay, and what happened after the seasons is over, the way they are getting a collection, they are going to reduce this balance and free the balance for next season. Balance for next season. So that's why it is revolving credit. It is not against any invoice. Okay. Before borrowing, okay, then there are some other like bank overdraft, OD. It is more or less like line of credit. Okay, so it can be unsecured. And the working is more or less like a line of credit. Okay, then there is a working capital term loan. Generally, you will not get the term loan for working capital. You will get the credit line or the overdraft. Okay, in only specific situation you will get the working capital term loan. So it is basically what happened means if there is a stuck up stock, okay, or stuck up debtors, okay, with respect to specific situation, okay, your credit line is insufficient to cater your daily needs. Means you have a credit line, okay, and what you did, you with the help of this credit line, you brought the stock, okay, but you as you're not able to liquidate this stock, this will you're not getting the amount, and because of that reason you are not clear your credit line or free your credit line. Okay, so if this kind of situation arises, then you may approach to the bank and you can inform that these are some stuck up stock or debtors. Okay, against this you need working capital term loan. Means you decided that you are going to liquidate this in a 3 year. You cannot liquidate this in a regular operating cycle. Okay, so working capital term loan you will get it. Why you are able to get it? Because you cannot liquidate or collect, okay, within reasonable operating cycle. Operating cycle. Okay, as you cannot liquidate or collect within reasonable operating cycle, then you need to approach to the bank for working capital term loan so that you will get the additional limit and your regular credit line get free. Okay, so that is basically the working capital term loan. Are you clear with this? Then packing credit. Packing credit generally prevail in India. Okay, so whenever you are planning to do export, okay, so there is a certain arrangement from the bank side or the government side that for export there make available the finance with a cheaper rate. Cheaper rate. Okay, so generally you will get the tenure of 6 months from bank side. Okay, regular interest rate may be the 10%, but in packing credit you they will charge you the interest rate of 2% or 4%. Okay, but there is a one risk. Okay, because the packing credit you will get in export currency or the foreign currency. Okay, so you need to absorb exchange gain loss. Okay, say for the 4% is interest rate, but exchange rate increases by 10%. Okay, so more or less it is same. Okay, so that is basically the packing credit. Then bill discounting. Okay. So in bill discounting, what happened? The due date is maybe the 120 days. Means you will get from your customer the payment after 120 days. But this customer is basically empaneled with the bank, and bank is okay to discount his invoice. Okay. So what bank will do if they want to charge 1% per month, and the like 120 days means 4 months. So after deducting 4%, they will pay immediately. Immediately. Okay. So this is basically the interest component. Means you agreed with the customer that you will get the payment after 120 days, but in invoice discounting, that customer has a tie-up with the bank that if they pay early, okay, bank will deduct some discount, okay, and the bank will collect the amount from the customer directly, like this. Or sometime we need to, once we get the amount from the customer, we need to pay to the customer. So the same way, bill discounting, LC also, as we saw in LC. Okay, so LC is basically guaranteed by the bank that customer is going to pay after certain credit period. That is basically the LC. Okay, discounting is basically you can approach to the bank, means the customer is supplier can approach to the bank, okay, and whatever may be the amount secured under LC, they can get in advance, okay, by paying some fees or LC discounting charges. Okay, so these are some corporate arrangement. Then we need to see the borrowing capacity. Okay, so how we are going to calculate the borrowing capacity? Do you have any idea? We saw the ratios actually. I think we already discussed on this issue. Any guess? How we are calculating the borrowing capacity?
Based on the net worth and the capital.
Yeah, net worth and capital is one factor, of course. First, lender and borrower both are under risk. That you need to understand. Lender, whether he can get amount back, okay, and for borrower, whether he can earn sufficient amount so that can cover interest and principal. Okay, so both are under risk. Generally, means the first criteria, means there are so many criteria, but the first criteria is basically debt equity ratio. Okay, so I always say two portion of the debt and one is equity. Okay, even if business fail, it assume that 70% amount is recoverable. Okay, so this is 2:1 is basically the bare minimum. It should be more than two. Sorry, it should be less than two always. Okay, recoverable. Okay, so if this is the scenario, so whenever the lender giving a loan to the particular company, okay, he makes sure what portion of the amount invested by the promoters. Okay, and then and only then, and on the basis of that amount, they decide to give the loan. Means whether it is a bank or the private investor. Okay, so this way you are going to calculate the borrower capacity, and then there is a income, like there are certain time ratio, like interest coverage ratio. How many times you are cover the interest from your income? Okay, So these are certain ratios which we need to evaluate before giving any loan. Okay. So first thing, both the borrower and the lender, whenever like the borrower take a loan from the lender, he is also in the risk because he need to make sure his business gives sufficient earning, and with this earning he is in position to serve the EMI or principal and the interest repayment. And the lender is also at a risk because if the business get fail, so recoverability of his amount is difficult. So that is basically the borrowing capacity. First, we see generally the debt equity ratio, then there are certain profitability ratio, and then I mean the some other non-financial factor as well. Then debt covenant. Debt covenant, I think we already saw positive debt covenant, negative debt covenant. Okay, so creditors use debt covenants in lending agreement to protect their interest by limiting or prohibiting the action of debtors that might negatively affect the position of the creditors. Okay, debt covenant is basically the term sheet or the condition. Is basically the conditions of the loan. Okay, so they are basically the positive covenant. Positive covenant means what you need to maintain or you need to do as a borrower, you need to do. Okay, and then there is a negative covenant. Okay, negative covenant means what you cannot do. Okay, so some example of positive covenant and negative covenant. So it is, there is a limitation on issuing additional debt. Okay, so you cannot do, this is basically the negative. You cannot take a further loan. So it is negative loan. Okay, restriction on payment of dividend, you cannot give the dividend. So again negative. Limitation on the disposal, again negative. Dispose asset. Okay. And limitation on how the money, borrowed money, can be used. Means you can, I mean, you need to use the fund for intended purpose. So there is a restriction on use of fund. Okay. Why this kind of condition we need to put? Okay. Like first we see, this is basically the positive. Means you need to maintain the working capital requirement. Capital. Then maintain debt to equity ratio, all the ratios, debt to EBITDA. These are all positive because we are maintaining. Okay. Minimum interest coverage ratio, as we already discussed, minimum interest coverage ratio. This we need to achieve. This we need to, others are, we need to restrict. Okay. So why the lender put this condition? To protect his investment or to protect his recoverability of the loan. Okay. So maintain working capital means if the current asset is more than current liability, at least we can pay to the debtors, or we can liquidate the inventory and collect the cash and pay. Sorry, we can collect the debtors and we can pay we can sell the inventory and recover the amount, and then we can pay all our current liabilities. Okay, so it will not affect to whatever the amount lent by the lender. Okay, because the current asset and current liability, if the current asset is more than current liability, so whatever may be the investment, okay, done by the promoters and lenders is protected, because operating cash flow can meet out their own liability on their own. Okay, if the current asset is less than current liability, okay, so what happened, what if we collect 100% current asset, till some of the long term funds we need to utilize to make the payment of current liability, and that may go from first from this and then from there, then maybe like the if it is unsecured, okay, then both are getting a proportionate amount. Current trade payable and lenders both are getting a proportionate amount. Okay, so that's why we need to maintain the working capital ratio. Debt equity ratio, again, as I said, if there is a loss, then there should be a sufficient equity investment or the investment of the promoters which can compensate or which can cover the losses in a business. Okay, if the capital is 100, loss is 100, okay, and the loan is 500. Okay, already whatever may be the investment did by the company, that get wiped out in a loss. Okay, so investment is zero. Okay, so in that situation the promoters don't have any interest to run the business or repay the loan. Okay, so that is basically the issue. So that's why always like if the capital is 300 and loss is 50, so it is basically 250 and this is the 500, so it is 500 divided by 250, so it is 2:1, that is acceptable. Okay, so you need to maintain the proper debt equity ratio. If it is 0 to 500, no one is going to give you the loan, or the lender may ask a money on immediate basis. Okay, and the same way interest coverage ratio, if your current profitability is not able to cover your interest, okay, so makes no sense to do the business. In that situation also, the lender may ask their loan amount on immediate basis. So these are positive covenant. Okay, negative, you cannot take a loan, because when the original lender gave a loan, he thought that whatever may be the asset that will going to protect his fund. Okay, so if you take an additional loan, then the same asset means it creates a pressure on the same level of asset. So that's why also like the lenders may not allow to take an additional loan. Okay, then again cannot pay the dividend. So unless and until you are going to repay the loan of the lender, you cannot distribute the money to the stakeholder, to the equity holder. Okay, so equity holder has always has a last priority to get the money in the liquidation. If we already pay in the form of dividend, okay, so it is basically the injustice with the lender. So that's why there is a restriction to not to pay the dividend. The same way not to dispose of the asset, and the restriction on the use of the fund. Then violation of the debt covenant. If covenant, so if violate the condition of the debt covenant, so what would be the impact? Impact for the violation of debt covenant. Any guess?
The lender will has to repay the whole money.
Yes, loan become callable immediately.
Or it may go towards the court as well, the cases.
Yeah, but first thing is loan may get callable. There may be an increase in, if there is a restructuring, then increase in interest rate. Okay, because there is some penalty need to put on the like the borrower. Okay, so if you see the bank transactions, they always say if you breach any condition, you need to pay additional 2% interest. Then restriction on future borrowing. You cannot borrow the fund further. Borrowing. Okay, and last is basically mostly, I mean, there are so many other like damage to lender relationship, impact on financial statement because there may be a note, there may be a notes in the, we give some disclosure in the notes to account, okay, and there may be a renegotiation, and the lender may put further, further stricter condition. Put further stricter condition. Okay, so these are basically the impact of the default, if we default in maintaining the condition prescribed in loan covenant. Okay, then financing decision with working capital. What factors impact the financing decision of a working capital? Impact of financing decision on working capital. Okay. Okay. We take some example basically so that you can understand properly. If your operating rate of return on working capital investment 15% and bank is giving a loan at the rate of 20%. Okay, so is it wise decision to get the loan and then increase the business? And yes, either yes, no, or maybe. Operating rate of return on your working capital is 15%. Okay, and bank giving a loan with a 20%. Means sometime if you see the startup, okay, so they don't have a sufficient collateral, they don't have a sufficient their own net worth, and because of that reason they need to take unsecured loan. Okay, If they take an unsecured loan, they need to pay interest at very high rate. Okay. Sometimes the bank interest is not even sufficient to cover their contribution margin. Okay. Say for like in a like they are going to sell of 1000. Against this, the variable cost is 900. Against this, the variable cost is 900. Okay. So their contribution margin is 100. Okay. For sale of 1000, they need to offer a 12-month credit period. Okay, like product development need a time like this. Okay, and because of that reason, and on this investment, they need to pay 15% interest. Okay, so interest cost is 150, 1000. It is a 12-month. Okay, 1000, 150. So contribution margin is 1000. Interest cost is 150. Does it make sense to take the loan?
No, sir.
Yeah, because your interest expenses is higher than your contribution margin. Okay, so it makes no sense to take a loan and go further. Okay, also keep in mind in market sometime what happened, we say okay, today we are not in as we are in startup phase, so on initial days we need to earn the losses. Okay, so that you need to evaluate where you are getting a losses. Just because of less capacity utilization, if you are incurring a losses, that can be acceptable because you can manage it when your capacity utilization reaches to 100%. But if you are not able to recover your variable cost, makes no sense to create this kind of references unless and until you can reduce drastically or you can cut down drastically the variable cost when the volume picked up. If this is the situation, then maybe you can do it. Okay, but like in most of the cases, we generally observed whenever you're not able to cover your contribution margin, this business started to get the fills. Okay, because see, at this moment, if you start to quote 1000 as a price, in future you will maximum get the 1200 like this, 20% higher. But by that time, the variable cost also may increase by say for 1000, so it is 1050. So again, you end up with the 150 profit. Still, your whatever the profit you are earning, that you need to incur to make the interest cost repayment. Okay, so that's why generally avoid those businesses where you are not able to earn even contribution margin. Okay, then effect on working capital. So working capital is basically the current asset minus current liability. This is net working capital. Okay, assume my current asset is 100, my current liability is 80. Okay, and I utilize my credit line of 30. Okay, what this situation indicates? My required working capital or net working capital is 20, but still I utilize my credit line is 30. So what it implies?
Excess outflow of cash.
Yeah. So either you utilize the difference for long-term investment, or some personal benefit. Okay, in both the situation, you're not able to earn day-to-day profit. Okay, so automatically your interest coverage ratio goes down and you may not be able to pay your interest. So that's why always you need to make a balance in working capital. Okay, like you need to utilize the credit line only for financing the working capital, so that like whenever you are receiving the money from the customer, you should be in a position to clear the loan. Okay, So short-term financing is classified as a current liability and decreases the working capital. The extent to which an organization uses a short-term financing is depend on both amount of current asset if maintained and the risk tolerance of the management. So shorter the term financing strategy require current asset level to be sufficient to meet the short-term obligation. Okay. So here if you see your net working capital is 20 and your credit line is 30, that means your net working capital is not sufficient to meet out your credit line or short-term credit. Okay. So advantage and disadvantage. What is the advantage of financing the working capital finance? Advantage and disadvantage of working capital finance. Okay, first advantage we see. First, you are able to increase your business. If you have a proper working capital finance, okay, then you can give the credit in the market and you can increase your business. Okay. Then, because of credit line, you can ensure that you have a liquidity. Okay. Then may support seasonal requirement. Okay. So, like if you have a credit line, then maybe you can, I mean, first 6 months you have a less sales, but in next 6 months you have a almost double, triple sales. Okay. So that you can manage. Then flexibility to use. Why it is flexibility to use? Why the credit line we consider as a flexibility to use? Any guess? No long-term commitment. If you take a term loan, even though you are not utilizing, okay, you need to take it and then EMI started. Okay, here the flexibility, if you have a less orders, then you don't require to use the credit line and you do not require to pay the interest. Not required to use credit line. So that's why it is a flexibility. Okay. What are the disadvantages? Okay. Short-term borrowing rate always higher or mostly higher than long-term. Okay. So this is the first. Second disadvantage is because of credit line, we may lenient, or how I can say, we may our collection process may slow down. Okay, because our like requirement of working capital met out by the bank, so we may not aggressive as required in collecting the money. Okay, so if this is the case, then there is a increase in financial risk. Okay, then there may be a okay, if you have huge working capital, okay, This may create restriction on further financing. Maybe it is long term or short term. Or short term. So these are basically the disadvantage of the financing. Okay. Okay. So long term financing we will see in the next class. Anyone has any doubt till now? Any question for any portion?
So in the last class, you have made us to know about the how to apply for the exams and all. We didn't receive the formats.
Yes, yes. Okay. So I'll send it today. I forget actually in last week. I will send it today. I mean, how you people can apply for the evaluation process. I will send it today. Today. Beside that, any question?
So what's the syllabus for midterm?
Okay. So that is basically we are keeping only module one, means the first part.
When are the exams starting, for that?
It is same. Means you need to solve some MCQs. Then there is a certain theoretical questions. Okay, and one or two simulations. Because the first part is more theoretical, so you need to just thorough with the concept. And the more
Is
than
it about regulations, sir?
sorry.
This you're talking is about regulation
No,
or
no,
what?
no, no, no. Midterm for bar.
Oh, okay, okay.
Sir, when is it, sir? What date?
That information you can get from Sudipto. But in this month only, I think they are going to schedule the exam. Anything else? Okay, so if no further question, then we close the class for today.